Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Johnson & Johnson stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Johnson & Johnson develops medical devices, pharmaceuticals, and consumer packaged goods. Their well-known products are bandages, Tylenol medications, Johnson's baby products, Neutrogena skin and beauty products, and Acuvue contact lenses. In November of last year, the company said they plan to split into two publicly traded companies, one that focuses on consumer health, and the other company's focus is on prescription drugs and medical devices. The actual split may not occur until 2023. The only two companies that are rated AAA are this company and Microsoft. Johnson & Johnson is headquartered in New Brunswick, New Jersey, and was founded in 1886. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Zitra, Vienna, EuroTLX, Sao Paulo, Buenos Aires, Bulgaria, Colombia, Santiago, Kazakhstan, Lima, and Bern. Let's get started with the model. This is a large cap company, 489 billion market cap. They're trading at 186 a share, and they have 2.6 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have pretty consistent free cash flow, around $20 billion a year. They have not released their first quarter statement of cash flows, so I used 2021's number. But they did release their first quarter income statement, so that's why their net income and revenue are updated. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that grows from 15 billion to 20 billion. Revenue is the sales for the company, and that grows each year from 82 billion to 95 billion. This is the company's income statement. The top line is the revenue of the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was highest in the trailing 12 months at 64 billion. Below that is our operating expenses. These are all the expenses not directly related to generating the revenue. An example is marketing. Gross profit minus operating expenses gives you your operating income, and that was a little low in the trailing 12 months compared to 2021. Then other income and expenses. These are all the gains or losses not part of the company's core operations. When it's a big negative, it's usually an asset impairment. Then you have your pre-tax income, then your taxes, and the bottom line of the income statement is your net income, which is pretty strong each year. Here's their most recent income statement, the first quarter of 2022 versus the first quarter of 2021. And their revenue is 23.4 billion, up from 22.3 billion. Of the 23 billion of revenue, 11.4 billion is in the US, 12 billion is outside the US. Of that 12 billion, 6 billion is in Europe, 1.5 billion in the Western Hemisphere, and 4.5 billion in Asia, Pacific, and Africa. 13 billion of the 23 billion is from pharmaceuticals, 7 billion from medtech, and 3.6 billion from consumer health. Their cost of revenue is 7.6 billion, so their gross profit is 15.8 billion. Their gross margins are 68%. They spend 6 billion on marketing, 3.5 billion on R&D, and 600 million of in-process research and development. In-process research and development means they acquired another company and they took on their R&D. So their net profit in the first quarter is 5.1 billion, down from 6.2 billion. Earnings per share of $1.93, down from $2.32. They have almost the same number of shares outstanding as they do from last year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They generate a pretty consistent amount of cash flow each year, around $22 to $24 billion. They spend a few $billion a year on CapEx, since they're a manufacturing company. Operating cash flow minus CapEx gives you your free cash flow. And they do pay a dividend with their free cash flow. They also buy back lots of stock. They bought back $3.5 billion in 2021. Last year, 3.2 billion, 6.7 billion, and almost 6 billion. Every time a company buys back common stock, it decreases the shares outstanding and makes your shares more valuable. In 2020, they issued 11 billion of debt, paid down 3.7 billion. So they added over 7 billion of debt in 2020. And it looks like they added the debt for an acquisition, because acquisitions go into investing cash flow. And their investing cash flow was 21 billion in 2020. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. Both numbers look really good each year. Their revenue has been going up slightly over the years, and their operating cash flow is pretty steady. Let's look at the capital structure. 74 billion of equity, 34 billion of debt. They're 69% equity, 31% debt. And even though they have a lot of debt, they could pay off pretty much all their debt with the cash on their balance sheet. If they wanted to use their cash to pay down their debt, they would only have $2.1 billion of debt. This blue line is their equity balance since 2015. And you can see it's always well above their debt balance. And they have a lot of cash on their balance sheet. In certain years, they could pay down all their debt if they wanted to, or a big chunk of it. It's not good to pay down all your debt and leave yourself with no cash. It's like paying down your mortgage and having no money left to buy food. I gave them the middle whack on Finbox, 6.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for that 612 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $520 billion. We divide that by 2.6 billion shares. And we get a calculated stock price of 198. They're trading at 186, so they're trading at a 6% discount. It's a buy according to the model. I did a video on this company in January of last year when they were trading at 160. My target was 176. They passed that target and they're up to 186. My new target is 198. The company's revenue forecast for 2024 is 103.2 billion. For 2023, it's 100.3 billion. For 2022, it's 96.3 billion. And then to calculate their 2025 revenue, I just looked at the growth from 2023 to 2024. That's how I got their future revenue estimates. They convert 23% of their revenue into free cash flow, so I multiplied their future revenue estimates by 23%. That's how I got their future free cash flows. The website Simply Wall Street is a lot higher than me. They're at 266 a share. They're saying it's 32% undervalued. 11 analysts priced this stock, and the average price target is 193. The low is 173. The high is 215. Here's where the stock has been trading the last 5 years. You can see overall the stock has only gone up. There were a lot of dips here and there, but as long as you held it for a year, you should have made money. Here's a comparison of this stock with the S&P 500 and 3 of their competitors. Eli Lilly has done the best in the past 5 years, up 250%. AbbVie is up 137%. The S&P 500 index is up 80%. Pfizer and Johnson & Johnson have done the worst, up about 50%. They have a beta of 0.72, so the stock is not volatile. It moves less than the market. It's gone up 11% in the past 52 weeks, while the S&P is up 2%. The 52-week low is 156, the high is 187. And the stock is trading above its 50-day and 200-day moving average. 8 million shares are traded each day on this stock. All the shares outstanding are on float. 70% are held by institutions, and 1/2% of the shares are shorted. They increase their dividend each year. It's a quarterly dividend up to $1.06. The yield is 2.3%, which is 56% of their free cash flow and 56% of their net income. Their next dividend payment is on June 7th. So that means you have to own the stock on May 22nd or before to get that dividend payment. If you buy the stock on May 23rd or after, you will not get the dividend payment. Historically, they paid a pretty consistent dividend, between 2 and 4% a year. The forecast is for their dividend to grow slightly over the next few years, to hit 2.7% by 2024. In the company's history, they've done 5 stock splits, a 3-for-1 in 81, a 2-for-1 in 89, 92, 96, and 2001. Their employee count has been pretty steady each year, growing slightly. They're currently at 142,000 workers. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $37,000 today. That's a 14% annual return. The salary of the CEO is $1 million in 2021, and their total compensation is $14 million. In the past 12 months, only one insider activity, a sell of 3,770 shares at 176, which is below today's price. 70% of the companies held by institutions, 30% by the general public, and only 0.08% by insiders. Vanguard is the biggest shareholder at 9%, then BlackRock, State Street, Geode, and Northern Trust. Let's look at their financial ratios. They have a PE of 25, that's stock price over earnings per share, price to sales of 5.2, price to book of 6.6, and price to free cash flow of 24.8. They have a really high return on invested capital of 26%. They can easily cover their interest payments with their operating income. They have a high ROE of 27%. Their current ratio and quick ratio are above 1. In the trailing 12 months, they generated $15 billion of free cash flow. They have $16 billion of working capital, and they pay out $11 billion of dividend payments, so the company's really well funded. The best way to look at ratios is to compare them to companies in the same industry. There are 18 companies in the same industry as Johnson & Johnson, and this company is the largest in terms of market cap at close to $500 billion. They pay a similar dividend as the average. They're less leveraged than the average company. They're doing better on price to book, price to earnings, but they are doing worse in price to free cash flow and price to sales. Their 3-year annual revenue growth rate is only 5%, the average is 9%, but they do have a really high ROA and ROE. So to summarize, I have them trading at a 6% discount, but pharmaceutical companies are always in high demand, even more so after the COVID pandemic. And since JNJ is the biggest one, for those reasons, I think this is a great long-term hold. That's why I own the stock. I rank their free cash flow 7 out of 10, their revenue 8 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.